You're now tuned in to the Desire to Trade podcast, a show where we bring you the best figures of the trading world and teach you how you can become a successful trader. This is your host, Etienne Crete.
Etienne Crete here, founder of Desire to Trade. Welcome to episode 64 of the Desire to Trade podcast. This episode is going to be a little bit different from what we do usually on the podcast. I felt like it was time for me to do an episode solo and to help you out with what a lot of people were struggling with in trading. Over the past couple of weeks, I was talking more and more with traders and seeing what people in my academy needed the most. And what I realized is that there's a topic that comes back all the time. And I want to fix it once and for all. Trading strategies. Now you have no idea how many people are looking for the perfect strategy and the perfect thing to trade when they're going to trade Forex or anything else. Now that's totally fine because trading strategies are not easy to find. But I want to make sure that we get clear on what exactly you can trade. So I decided to do a series of podcasts like this. There's going to be maybe 2 or 3. I don't know exactly how many, but it will cover everything you have to know. And then your job at the end is going to be only to select what you want to trade. So in this first episode, what we'll do is we'll cover a couple of things that you have to think about first. Things like how trading strategies work and just having an overview of trading strategies overall. In the next episode, we'll cover the trending markets. So how to trade when the market is trending. Then we'll look at strategies for sideways market, because the market trends sometimes and the market is sideways sometimes, and you have to know how to deal with them. Now, just a quick reminder, if you haven't listened to the episode last week with Ram and Gil, you're missing out on something big. So check it out. It's available. It's right there, so you can check it out. And you'll really learn about how day trading works. And what lessons Raman got from her several years of trading successfully. So now that we're clear with all this, I want to get started with trading strategies. And the first thing I want to talk about is the difference between strategies versus indicator versus confirmation. I see so many people who struggle with this. They're going to pick one indicator, they're going to want to trade with that indicator, and that's going to be it. They're going to stop there. Okay, this is only part of it. So a strategy has to be something complete. A strategy is something that you can rely on to trade from the beginning to the end. So there's 3 parts to a good strategy. The signal, the entry, and the exit. Those are the 3 things you have to consider. So a signal is some sort of pattern in price that is telling you that price could go in a certain direction, or is more likely to go in a certain direction. That's the signal. The entry is going to be the place where you enter. The entry is not going to be the same as your signal. Like if you see a candlestick pattern, that might be your signal, but it's not your entry. Usually what you'll want to do is you'll want to enter below the candlestick or above the candlestick, whatever the case. So it's not the same at all. Then there's the exit. The exit is going to be pretty simple, where you exit the market. Now, a fellow trader once told me that the difference between a good trader and a really, really professional and good trader is how long they're willing to stay in their trade. That's the crucial thing you have to think about. So if you're exiting too soon, you're going to miss out on the whole move. If you're exiting too late, well, it's not that great. But you want to make sure to keep the trade open as long as you have reasons to be in the trade. That's how I think about it. Now, there are strategies for trending markets and for sideways market. Before you ever think about any strategy, the first thing you need to identify is what is the phase the market is in at this point. Are we trending? Are we sideways? And how strong is that phase? When I think about this, I like to use the principle of market phase. It was developed by Stan Weinstein. Now, this is something that I learned in private coaching, and that really made a huge difference in my own trading. So whenever we're going to be sideways, we're usually going to have the same highs or the same lows. Okay, you have two types. You have the foundation and the consolidation. If you see the same highs, same lows, and you have a clear range, that's pretty much foundation or consolidation. If we make higher highs and higher lows, though, now we're entering a different phase, which is the uptrend or the rise, as it's called. There's going to be different strength to the rise. But the important thing is that we need to have higher highs and higher lows, both of them at the same time. So if you see this in price, and if it's clear, then it's going to be a rise. Now at some point the rise is going to probably stop, and that's where you're going to enter a consolidation. Consolidation meaning price consolidates, and you're going to be able to draw two limits around the price. And this could vary in what it looks like. Could be a triangle, could be a range, could be like whatever pattern of consolidation you can figure out. Okay, there's many ways. But then at some point, price is gonna hopefully break down. Or breakout could happen, but that's where you're gonna enter a new phase. If price breaks down of the consolidation, you're gonna enter what we call a decline. Now what's the decline? Is you need to have lower lows and lower highs. The reason why I'm talking about this is that depending on the market phase, you are going to adjust your trading strategy. I believe Van Tarp said in his book, and that's really applicable here. You cannot have one trading strategy and expect it to work for every type of market. That's completely insane. And I truly believe that. So once you've identified this, let's say you're in a decline or in the rise. So in a trending market. Well, there's two things you can do. You can either buy on pullbacks if you're in a rise, or you can sell on retracement. Now there's kind of another way, which is to trade reversals. Okay, this is really not super reliable, so you might want to stay away from that. But buying on pullbacks and selling on retracement is going to be your best bet in that case. The one thing I want to tell you now is that when you're going to trade those pullbacks and retracements, you're usually going to have a lower winning rate. That is, you're probably going to win less trades than you lose. And that's really fine. But you expect to have a bigger reward. You expect your reward to be maybe 4 or 5 R. So 4 or 5 times your risk. But you're probably going to win 30 to 60% of the time. Okay, totally fine here. And I'm not a big fan of trading those pullbacks. It's just not my type. But it could be yours, so you have to decide. We'll get into the strategies to trade those in a future episode. We'll get really in details on how to trade pullbacks, how to trade reversal. And I'll do my best to help you out in the audio format. Or if not, check out my YouTube channel and I'll make sure to provide you with some example of trades. Then the next thing I want to talk about is when price is going to consolidate. Because I heard different stats about this. But oftentimes the price is going to consolidate. You're just going to be sideways. You're not going to have any trend. This is where my favorite strategies come into play. You could try to trade breakouts or reversals. Those are going to be the two main ones. Those are going to be pretty much the only thing you can trade when you have a range or a consolidation. So breakouts, we talk about price breaking out above a range or breaking down below. And reversals, then we talk about usually a failed breakout that's going to come back down strongly. A true reversal usually is not where price just comes to a limit and reverse. It's when price breaks a limit and comes back within the range strongly. Sort of a failed breakout. Now there's going to be different ways of trading this. And the one thing I want to point out is that you hear all the time about the fact that breakouts are not reliable, right? You probably heard that 1,000 times. And you've probably seen it too. But breakouts are really reliable if you know how to pick the right ones. Because some breakouts are going to be much more reliable. If you're going to have a breakout in a trend, it's going to be much more reliable. If you're going to have a breakout after a strong move, it's going to be more reliable, for sure. So you need to pick the right ones. And the same thing goes with reversals. You're not going to trade reversals in the middle of a trend, right? When you make higher highs constantly and higher lows. You're going to wait until price is exhausted or until you're in a range and you have a strong reversal indication. And we'll cover those, of course, in a future episode because I want to make sure it's clear and I want to make sure you know what type of indicators you can use to trade those. The last thing I wanted to do in this episode is I wanted to talk a little bit about the mistake people make when they are trying to trade or trying to set out a strategy and trade it. The first thing is that a lot of unsuccessful traders believe that price action is like a strategy and that they can only use price action to trade. Okay, this is correct if you put some rules to it. But price action alone is not a strategy. Okay, it's only a tool that you can use, but it's not a way to trade. So the best traders out there, the professional ones, are going to combine price action, meaning candlestick patterns, and price movement with other things. Because they can look at the market phase, they could look at exhaustion, they could look at candlestick size, but they're not going to look only at candlestick patterns. Because there's a big difference in that. And I see so many people looking only at engulfing candles or pin bars and wanting to trade those. Because you need to understand what the trend is, what the market phase is, how the price has been behaving, what's the strength of the candlesticks. You need to look at all of those before. And the other mistake people are going to make is they're going to trade reversals in a strong trend. They're going to see a strong trend. They're going to see an engulfing candle and they're going to enter the market right away. But you need to understand that in addition to candlestick pattern, you need to look at the size of the candlestick. If you're going to have an engulfing candle and 2 or 3 candles ago you had a big, strong trend bar, well, forget about it. It's not going to be reliable. So that's why the context and the environment before the signal you have is really, really important. Okay? And I want to make sure that you guys understand this and that you can apply it when you look at a chart. So don't think about only one candlestick pattern or 2 candlesticks. Think about the whole previous move, the whole trend, and the big picture. I always talk about that. The big picture, you need to look at it. And if you want to have more information about this, I have an article on my blog. I'll try to put the link in the show notes so you guys can check it out. So just go on thisartotrade.com/64 and you'll have all the links right there. And the next mistake I see people make all the time, and I've seen this a lot in my academy, is people are looking for way too much confirmation. Okay, they want to have the perfect alignment with indicators, with candlestick patterns, with movement. They want to see everything perfectly aligned. But it's going to be really rarely the case. And usually when everything's aligned, it's too late to enter the trade. It's just way over. And all the professional traders have done the trade. They're all out or soon to get out. And then you get in and it's going to reverse straight in your face. So you want to be really careful with this. Where instead of having confirmation, you want to focus on having confluence. And what does that mean? It means more indication in your favor. But not necessarily a strong confirmation that the price is really going your way. And the best example for this could be when you trade a breakout. So some people are going to trade a breakout, enter when they see that the price closing below the range, and closing below the candlestick that closed below the range. Okay, they want to have a clear indication that price is not going to come back to the range. And this is not working at all because it's usually too late. If you have a strong evidence that the breakout is going to work, well, there's no reason for you not to enter. If you're in a strong downtrend and you're early in the trend and you're breaking out, well, you could enter right away, in my opinion. Okay, that's only my way of trading, but you could do it usually because you know that you have more confluence in your favor. You have the trend plus the breakout. So you have to be willing to not wait for confirmation all the time. And the other example I could give you is I used to wait all the time to have a big engulfing candle to take a trade. I used to want to see a big engulfing candle. And sometimes I had it, sometimes not. But a good part of the time, when I was waiting, it was too late. I wouldn't have a good reward to risk. And I would still take the trade. But I would have like a 1.5, maximum 2 of reward to risk. But entering before this candlestick, I would have a huge reward to risk, like a 3 or 4 reward to risk. And this is going to make a big difference on your return. Having 2 of reward to risk instead of 4, it's going to make a huge difference. So you need to be willing to consider other things than price movement to enter your trade. So that could be the trend. That could be indicators that are helping you out. It could be the previous candlesticks that are really weak. And those are going to help you out to determine whether the price is really going to reverse or not. And of course, you might have some more losing trades. That's part of it sometimes. But you're going to have probably a bigger reward to risk. And that's totally worth it in the end. So to overcome this mistake, I would strongly suggest you to take a look at the big picture. And usually when you take a look at this, at the market phase, you're going to be able to identify where price is likely to reverse and where price is likely to bounce. And you don't need to be a pro at this. You just need to look carefully and practice a lot. One thing that could probably help you out is the lesson I have on my blog, Desire to Trade. Now this is a paid lesson and I offer it as a kind of bonus. It's only $7. So if you guys ever want to check it out, I'll put a link in the show note. It's really cheap and it's to help you figure out how to use a market phase and what to look at. And I'll tell you this made a huge difference for me in my own trading to really be clear and get the big picture view of what I was supposed to trade. That's pretty much it for this first episode. I just want to recap what we talked about here. We talked about the difference between strategies, indicators, and confirmation. Strategy is going to have all the parts. Indicators are just going to complete your strategy and help you trade better. Confirmation is not always needed, but you need to have some confluence when you trade. Then we talked about strategies for trending markets, strategies for sideways market, and last thing we talked about the mistakes you can make and the mistakes that so many people make. That is using only price action, trading reversal in a strong trend, so not using the good market phase to enter the right trades, and lastly the need to have too much confirmation. Don't forget that you should not look for certainty in the market. You're only looking to benefit from it and trading something that has an edge. You don't need to be certain all the time. And you cannot be. That's impossible. To close this off, I want to thank you for listening to this podcast. In the next episode, we'll look at in details what you can trade and what are the things to consider when you trade each type of trade. I'll do my best to provide you with tips and the type of indicators to use in different market phase. And I really hope we can solve the problem of trading strategies because it's something that is pretty easy to find. But again, I want to tell you that you need to do the work by yourself. You need to show up and backtest. You need to show up and test how your stuff works. And the best thing I can tell you is that you need to find something that's going to work for you. Okay, there's so many ways to make money. There's so many strategies out there. So many indicators. So many patterns. but you need to find which one you're most comfortable with. And then you need to become the expert at those strategies. I recommend you check out the show notes because there's going to be a lot of things in them. desiretotrade.com/64, and I'll provide you with all the things I talked about today. Now, if you need to reach out to me, check out the Facebook group at desiretotrade.com/group, and I'll do my best to connect with you there. Just send me a message, let me know how stuff is going for you, and I'll be there to help you out. So on that note, I'll see you in the next episode of the Desire to Trade podcast. Ciao.
Thanks for listening to the Desire to Trade podcast. To get all the information on this show, free articles, and unique resources, make sure to check out www.desiretotrade.com and subscribe. Please leave us a review and let us know what you thought about the show. It's time to become the best trader you can be. See you next time.